Now, China is the biggest buyer of our debt. What would happen to interest rates and our economy if it started selling those treasuries? Joining us tonight, Bill Adams is senior economist with PNC Financial Services Group. Bill, thanks for joining us tonight.
Thanks for having me, Bill.
It is considered highly unlikely that they would think about selling too many of their treasuries. But what do you think? And isn't it interesting they even brought it up in this tweet? What do you think would happen if they did start thinking about selling in size?
I think if we did see a large sale of treasuries by China's central bank, we would see treasury bonds fall. We would see yields move higher over a short period of time. But I think after that, it's likely that the Federal Reserve would intervene in the treasury market and buy treasuries. That's what the whole point of quantitative easing was. And if they saw treasury yields moving in a direction that was out of line with their goals for the U.S. economy, then I think the Fed has the tools to bring interest rates back where they want them.
Art Cashin, down on the floor of the New York Stock Exchange with UBS, suggested that perhaps a worst-case scenario would be if China just stayed out of the auctions and didn't buy any more U.S. treasuries. What do you make of that scenario?
I think China has already stepped back quite a bit from financing the U.S. government. Chinese foreign exchange reserves peaked at around $4 trillion U.S. dollars a few years ago, and now they're down to around $3 trillion U.S. dollars. So China has already changed from being a net buyer to a net seller over a multi-year time horizon. And the 10-year government bond yield is only 2.4% right now, and the U.S. economy continues to grow.
But again, we don't want to panic anybody. It's highly unlikely that the Chinese would sell too many of their treasuries. Why is that? Let's explain that.
Well, China owns treasuries not because they like the U.S. government or they want to finance it, but because it's an insurance policy against a shock to the Chinese financial system. Treasuries are a risk-free asset in the United States, and the U.S. dollar is the world's reserve currency. So having treasuries is a buffer against bad things happening outside of China and infecting the Chinese financial system. With this conflict between the United States and China and downside risk to global growth, all the more reason that China doesn't want to tear up its insurance policy today.
Bill Adams with PNC Financial Services Group. Again, thanks for joining us tonight, Bill.
Thanks for having me.